The U.S. economy added a mere 57,000 jobs in June, shocking analysts and investors alike. This disappointing jobs report has sent ripples through the stock market, altering expectations for Federal Reserve interest rate decisions. Here's a detailed breakdown of this significant economic event. Looking ahead, the Federal Reserve is expected to hold interest rates steady in July, marking a significant moment for the economy. This decision comes at a time when inflation appears to be stabilizing, particularly as energy prices decline from recent highs. By pausing rate hikes, the Fed aims to give markets a chance to breathe and reassess economic conditions. This approach could influence investor strategies across various sectors, particularly as the economy grapples with mixed signals. Investors are likely to scrutinize any signals from the Fed regarding future rate adjustments, as these could have profound implications for market dynamics and borrowing costs, impacting everything from mortgages to corporate loans. In the broader context, the upcoming earnings season is anticipated to be challenging, especially with recent weak jobs data raising concerns about consumer spending. The labor market, traditionally a strong pillar of economic stability, is showing signs of strain, prompting companies to implement cost-cutting measures to maintain profitability. However, certain sectors are displaying resilience. For example, the electric vehicle market continues to thrive, and defense spending remains robust. Rivian stocks surged by 5% following optimistic delivery forecasts, while AeroVironment experienced a 5% increase after securing a substantial Army contract. As we analyze the potential impacts, the small-cap market rally may persist if interest rates remain low, fostering an environment for growth. Conversely, the AI infrastructure sector is likely to face increased volatility as investors reassess which companies are best positioned for future success. The overarching question remains, how will the Fed's decisions and evolving market conditions shape employment and economic growth in the months ahead? As we approach the latter half of the year, the focus will shift to how these developments influence consumer behavior and business investments, ultimately determining the economy's trajectory through 2023 and beyond. The weak June jobs report results reflect a troubling trend in the labor market that has persisted throughout the first half of 2026. Several interconnected factors have contributed to this situation. Post-pandemic hiring fatigue has significantly hindered many businesses' abilities to restore their pre-pandemic workforce levels. This challenge is intensified by an increasingly competitive labor market, where job seekers are taking a step back to reassess their career aspirations, leading to a more selective hiring process. Compounding these issues are ongoing geopolitical tensions, particularly the conflict involving Iran, which injects uncertainty into the economic landscape. Such tensions can disrupt supply chains and elevate operational costs, prompting companies to hesitate in expanding their workforce. Additionally, earlier spikes in energy prices exerted pressure on businesses, forcing them to limit hiring as resources were diverted to manage rising operational expenses. Although the economy experienced a growth rate of 2.1% in the first quarter, surpassing initial expectations, hiring remained stagnant due to a prevailing cautious optimism among employers. The broader trend of slowing job growth in the second quarter further underscores this reluctance to invest in new talent. This conservative hiring approach not only affects job seekers, but also poses risks to consumer spending and overall economic growth. Looking ahead, analysts suggest that a stabilization of global events and a decrease in energy prices could rejuvenate hiring efforts in the latter half of the year. However, businesses must adapt to the evolving labor market dynamics to fully leverage these opportunities. By embracing innovative hiring practices and flexible work arrangements, companies can position themselves to attract the talent necessary for future growth and stability in an uncertain economic environment. The June jobs report has revealed that the U.S. economy added only 57,000 jobs, a figure that falls significantly short of expectations. This disappointing number effectively diminishes the likelihood of an immediate interest rate hike by the Federal Reserve. In recent months, economists had anticipated a stronger labor market, which is often viewed as a sign of economic health and recovery. However, This latest data raises questions about the resilience of the labor market and its implications for monetary policy. Historically, job growth has been a critical indicator of economic stability, influencing everything from consumer confidence to spending patterns. The underwhelming job creation figure indicates potential underlying weaknesses, such as sluggish business investment and cautious hiring practices, which may be linked to broader economic uncertainties. For investors, this presents a complex environment filled with both challenges and opportunities. Lower expectations for borrowing costs may provide relief to growth stocks and the real estate sector, both of which are particularly sensitive to fluctuations in interest rates. The market has already begun to show signs of rotation, with small-cap stocks attracting inflows of approximately $8.74 billion since May 1. This shift indicates that investors are increasingly seeking higher yields in a potentially lower-rate environment, prompting a focus away from large-cap stocks. The tech sector, especially companies involved in artificial intelligence, is facing increased volatility. For instance, while Meta's stock surged nearly 9% due to positive developments in cloud services and AI, competitors like CoreWeave and Nebius Group experienced declines of 14 to 17%. This divergence underscores the intense competition within the AI market and the broader market's reaction to economic signals. The average person should pay close attention to this report, as it could serve as a bellwether for future job growth, wage increases, and the overall health of the economy. These factors have far-reaching implications, affecting everything from consumer spending patterns to savings rates. As job growth slows, it may lead to stagnation in wage growth, which could dampen consumer confidence. Looking ahead, the Federal Reserve may adopt a more cautious approach to monetary policy, keeping interest rates steady for the foreseeable future. This could have lasting effects on investment strategies and consumer behavior, shaping the economic landscape in the months to come. On July 6, 2026, the U.S. Bureau of Labor Statistics released its June jobs report, revealing that only 57,000 new jobs were created. This figure is significantly lower than the 125,000 jobs that economists had predicted, raising concerns about the pace of economic recovery. The report also noted a surprising drop in the unemployment rate to 4.2%, down from 4.4%. This paradoxical situation suggests a relatively stable labor market despite the slow hiring growth, which has analysts puzzled. Earlier in the week, the ADP employment report had already set a concerning tone, reporting just 98,000 new jobs, the smallest increase seen in 3 months. These figures indicate a potential slowdown in hiring that could have broader implications for the economy. The weak jobs data prompted S&P 500 and NASDAQ futures to extend their gains in pre-market trading, leading to a flurry of trading activity. Investors quickly recalibrated their expectations regarding the Federal Reserve's next moves, anticipating that the central bank might delay any interest rate hikes. This scenario stands in stark contrast to earlier predictions, where many anticipated a more aggressive monetary policy response in light of inflationary pressures. The report marks the fewest jobs added in 4 months and has ignited discussions about the implications for the economic recovery and the broader market. Analysts are now considering what these employment figures mean for the overall health of the economy. Some suggest that the labor market may be facing structural challenges, while others argue that uncertainty in consumer demand could be playing a role. The decline in job creation may also hinder wage growth, which has been a critical factor in sustaining consumer spending. As the economic landscape shifts, the outlook for businesses and investors remains clouded. Looking forward, the Federal Reserve's response will be crucial in shaping the economic trajectory. If the central bank opts for a more cautious approach, it may signal a need for further stimulus measures to support growth. The upcoming months will be pivotal in determining whether the labor market can regain its momentum or if we are facing a more prolonged period of stagnation. As we consider these developments, how will the weak jobs report influence economic growth and employment rates moving forward? Share your predictions in the comments, and don't forget to subscribe for more daily deep dives.